Good day, ladies and gents. How are we all doing? I hope we are all good. So today I just came with a quick lesson, and I'll be speaking on the importance of marking out the previous day's high and marking out the previous day's low so that these levels can help you come up with a setup for your current day. So without wasting much time, so if you notice on my chart, this is a nasdaq chart. This was the previous day's high. This was the previous day's low, right? So you see here, I just marked above. That's where my point of interest is. I also had a point of interest right there. So why do we mark out the previous day's high and why do we mark out the previous day's low? So usually you'll find out that liquidity, that's where you find most of the liquidity here on the swings. So it can be the previous day's high or previous week's high or the initial high of the day or any old high. Same applies to the bottom side. It can be a previous day's low. It can be a previous week's low. It can be a previous month's low. It can be equal lows. It can be the initial low of the day. Usually that's where you find liquidity. And what usually happens is if this is your previous day's high and your, let's say your price starts off in the Asian session, then it trades towards the previous day's high. If we take out that high and we come back into the range of the previous day's high, so let's say that's the high, this is the low. If we come back into the range, usually this is where we start looking for a sell setup. So depending with how you've learned or what you've learned on trading, this is where you start looking for any confluences which line up with the sell trade. So personally, for me, I love to see a break in market structure, a retracement either into an order block, the same previous day's high value, or a fair value gap imbalance, any of those things, or equal highs sometimes. If I get any of those confluences, that's when I now look to enter sell. And usually price will come towards the lows of Asian session, and sometimes it will come as low as the previous day's low. But all we want to do is to catch a piece of the pie. So if you can catch 1:2, or if you can catch 1:3 risk to reward trade, that's still perfect. If you can catch something which you've calculated or aimed for, if you catch it within that move, then that's perfect. Price will end up doing whatever it does. You would have been done already for that particular day. So coming to today's setup, like I said, this was yesterday's high. We also have today's open price. So I had two confluences which were on the same area. So with this setup, what happened in the morning at London session is price actually took out these lows and they decided to push up towards these initial high of the day. So when we go to that high, we took out liquidity there, then price started to drop. So like I said, if I'm selling or if you're selling, you always want to get a break of market structure or a BOS or BMS to show that price is actually selling. So for me, that BMS or the break of structure only happened at this point. Right. So at that point now, my price was now back inside yesterday's range. So these are now confluences lining up. So during London, I did not have anything which I could have used to take a trade. So I just let the London session go. But as we were approaching the afternoon session now, which is my New York session, or the stock market open, if we zoom in on H1, you will notice that from this liquidity sweep here, price created a fair value gap here. That's fair value gap number one with this broken structure. So that made this area a point of interest. Then they created the second fair value gap just before the stock market opened. And when the stock market opened, they actually wicked into this gray zone, which you're going to see on the M15 or on the smaller time frames. So at the same time, I had to look for a confirmation, which is usually one of the nameable four candles which we look for. If you don't know any of these candles, please check a video which I'm going to link at the end of this particular video. It will just be at the end. You can watch it. So I'll be looking for 4 nameable candles, which are a pin bar, a bearish engulfing, an inside bar, or a doji. If I get any of these 4 candles on a point of interest, that's what triggers my setup and my entry to be valid. So here you see we got that doji, we had the H1 fair value gap, we also had the Thetan EMA. These were all confluences which were acting as resistance. So as soon as I got that, it also happened right as the stock market was opening. So if you check, just as we were about to open, that's where that doji was forming inside the H1 FVG. We also had that M15 doji on the Thetan EMA. So this is just my notes on my chart. At the top, you see you see today's open price and that H1 FVG and the previous day's high, which was also in the same area. So I just entered at the break of this level, and I also used the break of this order block to confirm my entry. So in terms of take profits, I secured 1% on this particular trade, as you see, and my exit was actually here, which was a little bit early. So what I would advise you is, like I said from the beginning of the video, always try to aim for 1:2 or 1:3 risk to reward, or if you're trading indices or any other indices, you try to aim for an average of 100 points, then call it a day. So the next TP point was this one, whereby price had now moved about 150 points. I think by the time we got here, it was already 200. So the whole setup as a whole was pretty much good from the analysis from the higher time frame coming all the way to our entry time frame, which is the 3-minute. So also you will notice that we've got a trend all the way from the London high. Price was starting to come down. We've got price creating lower highs here, then dropping all the way, retracing a bit, dropping, retracing, dropping, liquidity sweep, dropping, retracing, dropping. So this is an example of a downtrend. So each time you identify a downtrend, just know that a downtrend is not always like this. A normal downtrend is like this. So you get your break of structure, price comes down, you might get a liquidity sweep here, then price continues to push down, then you might get another liquidity sweep here, then price continues to push down. So these moves are usually the ones which confuse people, because people start to buy. But because you already know this information which we're sharing right now, you should know that just mark these highs. As price leaves these swing highs, just mark them. Then you want to see how your price is reacting on those areas. So you see, we actually had another liquidity sweep there. Then price dropped, and we had this liquidity sweep, which we used to actually get into our trade. So if you're trading towards moving averages, you can use the moving averages as your TP. If you're trading towards any higher time frame zones, you can also use these zones, those zones as TP areas as well. So if you enjoyed this session, if you learned something from this lesson, please do give us a subscribe, a like, and a comment. You can also share what you learned. Also let us know what you trade as well. Like I said, I'm going to paste that video right in the center here, which speaks of the nameable candles which we want to see to confirm our entries. So if you watched until the end, thank you so much. Enjoy the rest of your day. Good trading.